Suzlon, MRF, Dixon, Geo Finance, TCS, Reliance, Bajaj Finserv, Sun Pharma, Airtel, HDFC. You can buy all of the 750 stocks just for Rs.10. Yes, just for Rs.10. I know what you are thinking. Is this a joke? You can't even buy Maggie for 10 rupees these days. You might say that with Rs.10 you can at best buy 1 or 2 shares of penny stocks like Vodafone Idea, JP Power, GTL Infra or Nandan Denim. Well, that is absolutely not true. Watch the video till the end. You will see for yourself how you can buy 750 stocks with just 10 rupees, and most importantly how you can do swing trading according to market movement. In today's video I'll share the complete strategy and the instruments used in the strategy in full detail. Don't treat this as another random video and skip it. Watch till the end. India has more than 6,000 listed stocks. There are roughly 100 large cap stocks, 150 mid cap stocks, 250 small cap stocks, and the rest are micro cap and some are penny stocks. Most retail investors have limited capital for trading and investing. Because of that, they end up investing in only 10 to 15 or 20 to 25 stocks. As long as those stocks do well, there is no problem. But when the market corrects, their portfolio often goes down by 50%. Don't worry, today I will show you a solution that solves all these problems. Most importantly, it will let you invest in India's top 750 stocks with just Rs.10. Before we explain the full strategy, you need to understand ETFs, exchange traded funds. An ETF is like a mutual fund, but it is listed on the stock exchange and you can buy and sell it like any other share. Unlike mutual funds, ETFs trade on exchanges and their prices change in real time. Mutual fund prices, on the other hand, are updated after the market closes. Because ETFs are trade like stocks, you pay brokerage on ETF buying and selling orders. You don't pay brokerage on direct mutual fund purchases. However, mutual funds usually have a higher expense ratio than ETFs, so brokerage should not worry as much when buying ETFs. Here is another fact you may not know. You can buy many mutual funds without a demat account, but to buy ETFs, you must have a demat account. ETFs are traded via your demat account. You buy and sell them like any other stock. I hope this explains the ETF basics and the principal difference between mutual funds and the ETFs. Now I'll explain why ETFs matter. Suppose you are bullish on the FMCG sector in the coming months, but you do not want a stock specific bet because that is risky. It is possible that the FMCG sector performs overall well, but the specific stock you chose does not. Even though the sector rose, your stock may still fail and you may not get the returns. Also, buying decent quantities of individual stocks requires a lot of capital. Some of these stocks are priced at 5,000 rupees per share and some are at 10,000 rupees per share also. To secure your returns, simply buy a good FMCG ETF. For example, you can buy the Kotak Consumption Fund that trades around 12 rupees of NAV. This ETF is a basket of FMCG stocks, so you do not need to pick one stock. Also, its minimum investment is just Rs.100. With Rs.100, you cannot buy even one share of top FMCG company. So with ETFs, you can start your stock market journey with very little capital. Talking about returns, in the last 1 year, this ETF has given about 20% return. So by taking a relatively safe, diversified bet and minimizing stock specific risk, you could easily earn 20% without analyzing even any single stock. You have heard the saying, don't put all your eggs in one basket. In the stock market, that means do not put all your money in one place. Diversification is very important in investing. By investing in ETFs, your portfolio gets instant diversification. With a single investment, you get exposure to many companies with limited capital and a lower expense ratio. This is why ETFs are so hyped and why everyone is chasing them now. ETFs come with many types. Some are sector specific and track a particular sector's performance. Some are index based ETFs tracking indices like Nifty 50 or Sensex. These are gold ETFs as well, debt ETFs as well, and global ETFs as well. Generally, ETFs do not need active management like some mutual funds. That's why their expense ratios are comparatively low. Today, I will tell you 4 top ETFs that can give outstanding returns along with a perfect trading strategy. And the last ETF which I will discuss is the best ETF in the world as per my opinion. So watch this video till the end. Number 1, Angel One Nifty Total Market market ETF. This is India's first ETF that lets you invest across 22 sectors and 750 companies. Wow. The Angel One Nifty Total Market ETF is designed to track and replicate the Nifty Total Market Index. The Nifty Total Market Index includes all stocks from the Nifty 500 and Nifty Microcap 250 as well. So a total of 750 stocks. It covers almost all the large cap, all the mid cap, all the small cap and 250 micro cap stocks. Since this ETF replicates that index, it holds those same 750 stocks. The weights of these stocks are based on free float market capitalization. A stock with larger market cap gets a larger weightage. Weights change with stock performance. The index is reconstituted semi-annually. Stocks are reviewed and poor performers are replaced with better performers. This reconstitution happens every March and September. Look closely in this total market cap. 60% is large cap, 18.7% is mid cap, 10% is small cap and the remaining 11.2% is micro cap. In the Nifty Total Market Index itself, 60% large cap, 18.7% mid cap, 10% small cap and about 3.8% micro caps are included. So about 93% of the total market cap is covered by the Nifty Total Market Index. By investing here, you invest in this 93% market cap of India's total market. In terms of sectors, you get exposure to 22 sectors like financial, IT, realty, telecom, FMCG, automobile, healthcare, power, construction, media, utilities and more. In short, 750 stocks are across large, mid and small and micro cap, across 22 sectors, weighted by free float market cap with semi-annual reconstitution. Mind-blowing. This will take your portfolio diversification to the next level. I know you want to know the returns. How much money will this make? The Nifty Total Market Index has consistently beaten the Nifty 50 and Nifty 500 over 1, 3, 5, 7, 10, 12 and 15 year periods as well. Don't believe me? Check it yourself. As of 20th January 2025, 1 year return 12.59%, 5 year return 18.51%, 10 year 13.41% CAGR and so on. So 1 lakh invested will become about 2,33,000 in 5 years, whereas the same amount invested in Nifty would have become only 2,02,000. With negligible extra risk, you could earn roughly 30% more by taking this calculated exposure. Choose according to your risk appetite. If you want to buy this ETF, go to your broking app, click on ETFs and search for A1 Total. You will see the chart, buy and sell option as well like any other stock. Click on buy, enter the quantity, confirm and done. Buying ETF is as easy as buying any other stock. Next best ETF, Nifty 50 ETF. This ETF is for people who do not want high risk and are happy with decent returns. A Nifty 50 ETF tracks the performance of India's top 50 companies listed in the Nifty 50 index. By investing in it, you are basically investing in those 50 companies as the Nifty comprises. The benefit is instant diversification, lower risk and potential long-term growth because it represents India's top performing companies. When selecting any ETF, you must check certain parameters. First, assess your risk appetite and investment tenure. Pick the ETF type accordingly. Then check the ETF's 1 year, 3 year and 5 year returns. ETFs can give negative returns in short term like other funds. So checking up to 5 years return is very important. Next, check the fund's tracking error. This may be a new term for many of you. ETFs replicate a benchmark index. Sometimes the ETF's performance can lag or lead the index. Reasons include corporate actions, fund expenses, upper or lower circuits in the stock, and other factors. The difference between benchmark and ETF performance is the tracking error. Always pick funds with zero or very low tracking error. It means the ETF closely replicates the index. Statistically, you can relate it to standard deviation. Also, analyze expense ratio, AUM and trading volumes, that is liquidity. Choose ETFs that score well on these factors. Don't worry, I will show this selection live. Out of over 100 Nifty 50 ETFs, I made a top 5 list for you based on this parameters. Our options are Nippon, UTI, Aditya Birla, SBI and Motilal Oswal. We will analyze and pick the best ETF. All these ETFs have no exit load except Aditya Birla. The rest trade around Rs 250 range. As of 28th March 2025, 1 year, 3-year and 5-year returns of total return index Nifty 50 are roughly 6.65%, 12.26% and 23.49% respectively. All our selected ETFs have outperformed this benchmark over the 5-year period. There is a difference between Nifty 50 and Nifty 50 total return index. Our ETFs use the total return index as the benchmark because total return index includes dividends along with price gains. So always compare ETF return with the total return index of the underlying index and not the main index. In the 1-year and 5-year period, Nippon India Nifty 50 ETF tops the list. For 3 years, Motilal Oswal ETF appears the best. Expense ratio, Nippon and SBI have the lowest expense ratio at 0.04%. Tracking error, UTI and SBI has 0 tracking error. Nippon and Aditya Birla have 0.03% tracking error. You might think we should eliminate those two, but hold on. UTI and SBI have tracking error 0, but have only been running for about 10 years. Whereas Nippon has been operational for 24 years and Aditya Birla for 14 years. So 0.03% tracking error is acceptable given the longer track record. We will eliminate Motilal Oswal because its expense ratio and tracking error are the highest. Now we have 4 funds left. Among them, Aditya Birla has very low AUM, only about 2,864 crore, while SBI has 1,76,989 crore. That is a big difference. So we drop Aditya Birla. Now 3 ETFs are remain. Looking at liquidity, UTI has the lowest liquidity among the 3, so we cross it out. Now we are left with Nippon India Nifty 50 ETF and SBI Nifty 50 ETF. Nippon tops the liquidity with volume of 90,55,773. Considering 1 and 5-year returns, expense ratio and liquidity, Nippon tops the list. So Nippon becomes our first choice. SBI is a strong second option because it has lowest expense ratio, tracking error is 0 and the largest AUM. By investing in a Nifty 50 ETF, you get exposure to blue chip stocks like Reliance, TCS, Wipro, HDFC Bank, ITC, Infosys, Bajaj Finserv, Titan and many others. If you want slightly higher returns and can take more risk, consider Nifty Next 50 ETF. This index tracks the next 50 companies after Nifty 50. It is riskier than Nifty 50 but less riskier than Nifty Total Market Index. The Nifty Next 50 includes big names like MRF, HAL, D-Mart, Adani Power, Tata Power and many others. The Nifty Next 50 Total Return Index 1-year, 3-year, 5-year returns are 4.76%, 16.62% and 26.22% respectively. We analyze the top 5 ETFs for the next 50 index as well. UTI, ICICI, SBI, HDFC and Nippon. ICICI has the highest 1 and 5-year returns. UTI has the best 3-year return at 16.04%. Based on returns, we eliminate HDFC because it is a new ETF launched in 2022 only and has lower AUM compared to others. Its expense ratio and tracking error are also very high. SBI ETF has the lowest volume, so we will eliminate it too. Now 3 options remain. ICICI has the lowest expense ratio at 0.1% and UTI has a tracking error of 0. Nippon has the highest tracking error and a higher expense ratio, so we can eliminate it as well. Now we are left with UTI and ICICI Next 50 ETF. Both trade around Rs. 65. Considering 1-year and 5-year returns, low expense ratio and high liquidity, my top pick is ICICI Nifty Next 50 ETF. The second option is UTI Nifty Next 50 ETF. ICICI leads on returns and cost, tracking error is 0. So if you are a beginner or prefer a conservative approach, invest in Nifty 50 ETF. If you are a long-term investor who wants broader diversification, Nifty Total Market Index is the best choice. If you fall between these two, Nifty Next 50 ETF should be your bet. Final one is the gold ETF. This ETF tracks the domestic physical gold price. Usually one ETF unit represents 1 gram of 99.5% pure gold. Gold ETFs are a very good long-term investment. They widen your portfolio and act as a hedge during volatile market. I strongly recommend having gold ETF in your portfolio. There are 20 plus gold ETF in the market. I filtered 7 and put them on the screen. UTI, SBI, Axis, Nippon India, HDFC, Kotak, ICICI Prudential. Let's find the best among this. None of this ETF have an exit load. Their market price is currently around Rs. 75. As I said, returns will be similar because they all track gold. Differences in returns occur due to tracking error and expense ratio. Let's check it out. UTI Gold ETF has been active for the last 18 years and still has tracking error of 0. Its consistency is outstanding. Expense ratio wise, UTI and ICICI Prudential have the lowest expense ratio as 0.5%. In 1 year returns, Kotak tops the list with 31.03%. For 3 years, UTI leads with 18.82%. For 5 years, HDFC tops the list. HDFC is also second best in 1 and 3 year returns. Talking about AUM and volume, Nippon India Gold ETF leads with a massive 18,779 crore of AUM and volume 97,52,174. But larger AUM and liquidity are useless if returns are lower and expenses are higher. From a long-term view, let's eliminate ETF that have given less than 14.2% in the 5-year period. That removes SBI, Nippon and ICICI. Kotak has high expense ratio and tracking error, so eliminate it as well. From the remaining 3, HDFC has highest expense ratio, so we remove it too. Now we are left with UTI and Axis. Both are good, but Axis Gold ETF is the clear winner. It has the best 5-year return and is second best in 1 and 3 year returns. You can include Axis Gold ETF in your portfolio. If you want a second option, choose UTI Gold ETF. It has 0 tracking error and the lowest expense ratio. Its 3-year return are the highest. However, note that UTI's AUM is only 1,712 crore. Still, UTI's AUM and volume are decent, so it is the second best option. I hope this video gave you good knowledge about ETFs and helped you choose the right ETF for yourself. Tell me in the comment section which ETF you are planning to buy. If you like the video, like it, share it with all your friends and subscribe to the channel for more such interesting videos. Thank you.